Now let's turn to look at the wealth strategy and strategy fund range from True Potential. Firstly, starting off with 7IM, the True Potential 7IM fund range posted some strong figures in January. 7IM are positioned for a brightening outlook but moderate fiscal and monetary stimulation. They project moderate global growth for 2017 and are positioned towards a stronger US dollar. The key diversifiers within their funds are alternatives, such as their inflation-linked note and their dispersion trade. In general, their alternatives have performed well and they have increased their weighting to this area at the expense of bonds, an area they feel could sell off, although they are happy holding a small allocation to US Treasuries. Within equities, 7IM are favouring a value style and have added to Japan, feeling that they could see growth in this area. Lastly, within emerging markets, they are underweight their strategic allocation as a whole and are skewed towards India. Now, Allianz. Allianz have taken a contrarian view to our other fund managers, feeling the equity markets are stretched and nervous that the Trump administration won't deliver. Allianz are concerned that the US dollar is looking too strong and have adjusted their positioning accordingly. They were overweight the dollar, but this has been adjusted back to an underweight position. Allianz have the ability to react very quickly to how events may change markets and can add or reduce risk depending on the levels of volatility within markets. Looking towards 2017, Allianz feel that they will use less of their risk budget compared to 2016. The True Potential Close Brothers fund range was one of the best performers for the month of January. Close are cautiously optimistic on equity markets, but currently cautious on fixed income, keeping an eye on what they feel is a good entry point for yield levels to increase weightings. Starting off looking at asset class weightings, Close Brothers over the last few months have been reducing exposure to fixed interest. The duration of the funds is around 3 to 4 years, with cautious income around 5 years. The big question Close Brothers are asking is how long will the Donald Trump rally last? Close have reduced their exposure to the US and increased their UK exposure, taking the view that they are seeing a honeymoon period since the US election, but are concerned that we could see increased volatility in this area, with markets moving sharply on the slightest comment from Trump. For the income fund, alternatives are now playing a bigger part, with alternatives offering income but also inflation protection. The fund overall is yielding 3.5%. Now turning to Schroders. The True Potential Schroders fund range has posted some solid performance figures over the month. Schroders feel that we are seeing a change in how investors view markets. The last 4 to 5 years they have been concentrating on lower for longer, which has led to massive imbalances in asset classes. Looking at the US versus Europe, Schroders see more value in Europe, with corporate profit margins still below their prior peak, but US margins are now at elevated levels. They feel that the US is more late cycle and that incremental growth doesn't come without inflation pressures. Moving on to fixed interest, Schroders feel that yields are too low to increase exposure currently if we are moving into an environment of rising inflation, and they feel it is dangerous to assume bonds are a low-risk asset in current markets. Schroders hold alternatives as a way to diversify their fund range. Cash levels are around 28% for the balanced fund, and Schroders receive around 0.7% return on cash held, which could rise if yields climb further. The True Potential Threadneedle Monthly Extra Income Fund lost ground over the month as UK equities generally underperformed most other asset classes. As a UK fund, Threadneedle are conscious of how Brexit plays out, but feel that holding a quality portfolio of stocks is the best way to navigate through potentially negative events. Threadneedle are less positive on fixed interest, taking a low duration position of around 6 years compared to the index of 8.5 years. Threadneedle have also been reducing credit risk, reducing exposure to areas such as banks. The fund is currently yielding around 4%, and Threadneedle are positive on the sustainability of this level of income, with a full year of currency devaluations helping to provide higher income levels. For UBS, looking at markets, in the US, UBS feel that there could be a pullback, not necessarily in equities, but potentially more in bonds. Normally where the US leads, other developed markets follow. However, they feel there is a disconnect between the US and Europe. Looking at the dollar, UBS feel that we are in the late stage of strength, although with their currency fund, CARS, they are overweight. Moving on to China, they feel it will perform well in the near future, but could struggle later in the year. UBS are very much positive on emerging markets, feeling that valuations are low and nervousness around a stronger US dollar is overdone. SCI continue to offer a solid performance. They have changed managers, removing AllianceBernstein from their US small cap building block, as they felt the team was becoming too large, and style-wise they were more focused on stability and quality as a style. SCI are more positive on the US than many of our other fund managers, and do not feel that we will see increased volatility on the back of the implementation of Trump's policies. For the True Potential Goldman Sachs Income Builder Fund, Goldman Sachs remain constructive on equities, increasing their position up to 56%, as they feel the equity risk premium is still attractive. They have, though, been trimming financials, tech and profits, reorientating into the oil sector, buying the likes of Statoil. However, valuations remain challenging, and there are still tail risks. Looking forward, they feel consumer staples could be an opportunity, previously underperformed but offer better valuations. So for Goldman Sachs Dynamic, the fund is overweight US equities, Japanese equities and relative value. Goldman's are positive on relative value, as they see the interest rate differential between bonds and credit spreads tightening. Over the month, they have been reducing that very large overweight position in US equities, which is a reflection that Trump may struggle to push through Congress many of the policies he proposes. They are underweight gilts due to bond momentum, and they feel that we are entering into a new world, but this new environment is still unclear.